Hi, this is Professor Mead, and the purpose of this video is to provide you with some instruction using an actual financial report in how to collect and enter the data related to the fifth written assignment for the semester, which has to deal with GASB Statement 53 and the reporting of derivative instruments by state and local governments. This is a new kind of project, new kind of assignment that the program in the governmental accounting Masters of Accountancy has wanted to do for some time, to give you an assignment that not only helped you with the requirements of the course, but also provided something meaningful and useful to the GASB in its standard setting activities. And this is the first time we've done this, and so I thank you in advance for being guinea pigs, and also thank you for your patience when no doubt there will be some glitches that come up, and we will resolve them as we go along. Just be assured that nothing that happens is going to in any way negatively affect your performance in the course. Your performance is based solely on your ability to do what you're asked to do, and not in any way a product of any mistakes I might have made in doing this the first time. So with that disclaimer, let's move on. You have the assignment, which has a list of 10 questions with a lot of sub-questions, things that you need to look for in the financial reports of the 10 governments that you have been assigned. You know that not every one of those 10 governments actually has derivative instruments, and so you will not actually be entering information for all 10 of them, only for some of them. And I will explain to you what to do if you look through all of the financial report, you look in the financial statements, you look in the notes, and you don't see anything about derivative instruments, how to indicate that that government doesn't have any. The government that I have chosen to use as an example is the city of Riverside, California, which is a reasonably large government. It's just outside of the 100 largest cities in the country. It's probably somewhere around 110 or 105. This is the, as with all the other reports, it's financial statements for June, for the fiscal year ending 2014. Anywhere, most of them, between March 31st, 2014 for the state of New York, and then there are a bunch of December 31st, 2014 as well. This is the Excel file that you'll be working at. There are a number of tabs along the bottom here for collecting different information. We are going to begin, and this is set up pretty much in the same order as the questions in the assignment, with looking at the government-wide financial statements to see if any information is reported in there, and to look both at governmental activities and business type activities, and then we'll look at the other financial statements for evidence of derivatives as well. Governments are not required to show derivatives individually on the face of their financial statements, and to the extent that there are deferred inflows or deferred outflows of resources related to their derivatives, they're not required to show those separately either, although they are required in both cases to disclose information about them so that you will know what those numbers are. So I'm going to shrink the size of this Excel file a little bit so that we can do some entry here while still looking at what's on the screen for the city of Riverside's CAFR. In looking for the financial statements, you can certainly look for the title, but I find it's pretty easy to scroll through the thumbnails on the left-hand side. You can always tell what the MD&A is because there are graphs and charts in it, and somewhere shortly after MD&A appears to end is where you're going to see the financial statements. And in fact, here's the government-wide statement of net position. I'm going to make that a little bit larger so that it's easier to see. One thing that I need you to be careful about is to pay attention to how the numbers are expressed. These numbers are reported in thousands, and I want you, when we enter the information, and I'll show you this when I actually do it, to put the information in whole numbers, which may mean adding some zeros to the end of it to ensure that everyone is putting information in the same amount. This derivative instrument right here, that's among the assets and the governmental activities, it's not $49, it's $49,000, and that's what should be entered. So you need to be very careful about that, because not every government does it the same way. Most of the governments we're looking at are quite large, and so they're probably going to be doing their presentation in thousands, but depending upon the note disclosure, it might be in millions. So you want to pay very close attention to what they're reporting and how they're reporting it to ensure that you've put the right information in. So looking back at that Excel file, on the very first tab, which is for the governmental activities, the very first thing you need to enter here is the government name. So it's Riverside, it's in the state of California. And then type of government, we've got a drop down here, and you've got a choice among 5. This one's a city. And then the first thing is asking whether there are any derivative instrument amounts listed among the assets of the governmental activities. And in fact, we have seen there's one right here, derivative instruments of $49,000. So that's what we're going to enter right there. And then I've asked you to enter what the label is for that amount on the face of the financial statements. On rare occasion, and this is not going to happen very often, there may be more than one derivative item mentioned among the assets, and if there is, I want you to put that second item in there as well. And then, if there is at least one listing among the assets, then I'd like you to put in the total assets, which are this amount right here. So it's 1750113, and remember this is in thousands, so 1, 2, 3, add some zeros to the end. There you go. The next group here, and you'll see that as you scroll across, you'll still see what the name of the government is here. So as you're adding governments, you'll be certain that you're on the right line. Governmental activities deferred outflows. There is, in fact, a derivative amount listed there, which is $14,784,000. And the label is deferred charges in derivative values. There is no other item listed here, but we do want to put in the total deferred outflows, $19,880,000. There we go. Next, we're going to look to the section for the liabilities, and there is one there. And remember, you may not see any on here. They may be combined with other liabilities on the face of the financial statements. There are a number of governments that I have seen who don't show the individual deferred outflows and deferred inflows on the face of the financial statements, but show one total number. If they're doing that, there will be a note disclosure that will disaggregate that by the source of the deferral, so you will be able to get the information in one place or the other. And as we go to the notes, I'll show you where those places are likely to be. So the next group here, liabilities. There is a liability right here of $19,485,000. The label is again derivative instruments. There is no second item there. The total liabilities are right here, $569,022,000. And then lastly here, we're going to look at deferred inflows. There is a deferred inflow amount here. It's exactly equal in this case to the asset. It's $49,000. Deferred changes in derivative values. There's no other deferred item there. And the total deferrals happen to be $49,000 as well. So that completes the first tab. The next tab, and just as a reminder, you ought to save these things on a routine basis, is for the business type activities in the government-wide financial statements. You will see now as you look at each of these tabs that the name of the government just carries over from tab to tab, so you don't have to re-enter that. So let's go back and look here again at what's in the business type activities column. And there is, in fact, there's nothing among the assets, but there is a deferred outflow of resources related to the BTAs. So the amount for the business type activities for the deferred outflow of resources is $19,277,000. The label is the same one we had before, deferred changes in derivative values. Obviously that's too big for the cell here, so you can expand the size of the cell to fit it if you'd like. The total liability, total deferred outflows for the business type activities is $40,444,000. That's the amount right there. There is a liability amount. Now see, I've just made a big mistake here. These amounts actually are for deferred outflows of resources and belong over here. Mistakes are made. You just need to be careful and review what you've done. In the liabilities, we have one right here, $30,191,000. And the label is derivative instruments. And total liabilities for the business type activities right there is $1,313,997,000. And there are no deferred inflows of resources under business type activities here. So we are done with that slide, with that tab. And let's hit save again, just as a matter of course. It's a good thing to do on a regular basis. The next thing we're asked to do is to take a look at the government-wide statement of activities and see if there's anything in there. And the only place that you're likely to see anything would be if they listed something under general revenues separately. I'm not expecting that you're going to find very many, if any at all, identifiable flows related to the derivative instruments in the government-wide statement of activities, but this is where you would look. It's not going to be under taxes. It's all probably inside of investment income here, but you'd be looking under general revenues if it's likely to show up. And it's always possible that there might be a special item shown down here that is related to it, but probably not. So there's nothing to enter for the statement of activities. So we'll move on to the next tab, which is for the internal service funds as they're reported in the proprietary fund financial statements. We're not going to look at the enterprise funds because we just did business type activities, and except in very, very rare circumstances, those are exactly the same activities, and so the information should be the same. So let's go back to this. We're not going to look at the governmental funds because at present they're not. There's no reporting of derivatives in the governmental funds, but there is, under the accrual basis in the proprietary fund financial statements, and you can see, that most of these are the enterprise funds, which are the same as the business type activities. All the internal service funds are aggregated in a single column on the right-hand side. So let's look down here. What we're asked to do is look at, again, assets, deferred outflows, liabilities, deferred inflows. I don't see anything among the assets here that seems to be related in any way to derivatives, or among the non-current assets here. I'll take another scan just in case I missed it when I looked at it the first time, but I don't see any. under deferred outflows of resources, there is an item here, deferred changes in derivative values, as we saw in the government-wide statements. And you can see there are some items in these enterprise funds, but there's nothing in the internal service funds here. There are no items. That's internal service funds, right? It sure is. So these hyphens there mean zero. So there isn't anything there for them. Look under the liabilities now, and we can see that, in fact, there is a liability listed here, derivative instruments, with some items underneath, with some amounts underneath the enterprise funds. But again, nothing in the internal service funds. This is the line right here, and there's nothing here. There are no deferred inflows at all in this financial statement related to the enterprise funds or the internal service funds. So there's nothing to add here for the internal service funds. Unlike the government-wide statements where we had separate tabs, there is on the same tab for internal service funds some columns related to the income statement, otherwise known as the statement of revenues, expenses, and changes in net position for the proprietary funds, to take a look at this to see if there's anything related to derivatives on here. In fact, I don't see anything at all. They're most likely, if there are, to appear in the non-operating section. But as you can see, there's nothing here that clearly says that it has anything at all to do with derivatives, and so there's nothing to enter for that statement. The next tab has to do with the proprietary fund statement of cash flows, and in this case we're going to look at both enterprise funds and internal service funds because this cash flow information is not available in the government-wide financial statements. So what we need to do is to look down at these categories of cash flows and see if any of them say anything that seems to be related to derivative instruments. And just scanning this, I don't see any. The cash flows that are related to them are going to be in here somewhere, probably in capital and related financing activities, or if they're investment derivatives, in the cash flows from investing activities, but none of that's broken out here. It's all in large aggregated categories. So there's nothing to add for the statement of cash flows. So that gets us through the financial statements. So the next place we need to look is in the notes. So if you once again scroll down here, you can usually see where the notes begin because it's you're getting past things that look like financial statements and into really heavy text. One place where you might see something about deferrals, I mentioned that before, where there is some if they're showing a single number, where you might see the breakout might be in the first note, the summary of significant accounting policies. What you will notice in terms of order here, to get you through it quickly so you don't have to read through the entire significant summary of accounting policies, you want to scan through it, but usually it starts by describing the reporting entity, including any component units they have, before moving on to talking about the financial statements. So it'll talk about government-wide versus fund financial statements, then move on next to talk about measurement focus and basis of accounting for the financial statements, which may include identifying the funds that they're reporting. And then what it will do is start talking about individual elements that are reported in the financial statements and the accounting policies related to them. So cash and investments, restricted cash and investments. You should see inventory, prepaids, capital assets. You may see an item on derivative instruments, and you ought to take a look at this because some of the required information in the notes might show up here. So the combination of this and the specific notes related to derivatives later on in the statements, later on in the notes, you're going to want to look in both places. I've already read this, and I can tell you that there isn't really much in here that isn't covered in Note 10 on their derivative instruments. But you want to keep scrolling through here to see if they have, and they usually will, a note about deferred outflows and deferred inflows. And here is one right here, and they do basically talk about what deferrals are, and usually will say something about what types of deferrals they have or what the causes of them were. And this might be the place, if they've shown a single amount for deferred inflows or deferred outflows, where they give you that breakdown, but not always. There may be a separate note later in the note disclosures where they show the breakout by the source of the deferral. And in this case, we're looking at a government that showed it on the face of the financial statements. So we wouldn't expect to see any further breakdown anyway. So now let's go look for Note 10, because that's where we're going to find most of our information. And I'm just scrolling through here and guessing, although now I can see that because I highlighted some of it, easy enough to find what I'm looking for. It'll be a little harder for you looking through it. You're really just going to have to scroll through, unless they have a table of contents at the front of their notes section, which some states do and some large cities, but it's not required. It just is really helpful when they do. It's much easier to find what you're looking for. So this is the note disclosure specifically related to derivative instruments. Let's go back to that Excel file. And the first tab related to notes has to do with the required summary information about their derivative instruments. And so in looking at this, and you're going to have to, I think, read through the entire disclosure one time first, at least once, before you start trying to enter information into the Excel file. And then you're kind of going to be going back and forth, because although the questions in the assignment and the tabs in the Excel file are in the order of how the requirements are listed in Statement 53, they may not present everything in exactly the same order. So you're going to have to look around, and you may have to jump back and forth between what you see in the disclosure and the financial report, and then finding where to put that in the Excel file, or looking at the empty spaces in the Excel file and then looking back at the disclosure to see if you can find that information. So the first thing that is asked here is whether how the information is organized. And it's asking first, is it organized by type of activity, meaning governmental activity, business type activity, fiduciary activity? And in fact, they are in the presentation of information showing governmental activities and business type activities. So you can click yes. Now asking, is the information further divided underneath each of these activities between hedging and investment? And in this case, it's not. The reason for that is because all six derivative instruments they have are cash flow hedges. They're all hedging derivative instruments. They don't have any investment hedging derivatives. So it's not wrong that they're not showing the breakdown. It's just not applicable. So if you are in reading this, know that they have both types, and they don't make a distinction in the presentation of the information between hedging and investment. You should click no. But in this case, they only have hedging derivative instruments. If they only had investment derivative instruments, it would be equally not applicable to make that division. By the same case, the next question is, have they divided their hedging derivatives between fair value hedges and cash flow hedges? We know that all six of these are cash flow hedges, so that type of division is actually not applicable to this government. And then organized by type of derivative, again, we know that in this case, all of them are pay-fixed interest rate swaps, and so they don't have multiple types of derivative, and again, in this case, it's not applicable. Next, we're being asked if they presented the notional amounts, and they have. So first, we're going to say yes, they've reported them, and then put in the total notional amount for hedging derivatives. And again, we know that all they have is hedging derivatives, so there won't be any amount for the investment derivatives. This total happens to be $366,456,000. Okay, again, they're reporting their numbers in thousands here. I know that because up toward the front, it said that all the amounts were in thousands. You need to make sure that you're using the proper numbers. There is no investment total, so let's move on next to change in fair value. They do, in fact, show the change in fair value here. So we can click yes. Put in the total for the hedges, which happens to be $309,000. There are no investment derivatives. And then they're required to identify where in the financial statements these amounts show up, since they don't show up on their own line, as we've seen. Usually it'll say something like investment income, or in this case, because these are all hedging derivatives and the changes in fair values don't run through the income statements, the identification should say something like, in this case, deferred outflow of resources. In the positive ones, deferred inflow of resources. But they're not showing any identification here at all. And so the answer is no, they did not identify it. Did they show the ending fair value? Yes, that's it right here, as of June 30th, 2014. So yes, that is reported. Then the question here is whether it matches the statement. And in order to figure that out, you have to add these all up, and the total happens to be $49,627,000. $49,627,000 for all of them together. That's simple enough. We don't really need to look at governmental activities and business type activities separately. So let's go back to the statement of net position. And we see the liability amount's $49,676,000, but remember, we need to subtract from that the asset amount here, and I believe if you calculate that, it comes out to $49,627,000. So going back here, and back to the Excel file, the answer is yes, it matches the statement. You see here, if there was no number in the statement, then you can't answer yes or no. You just have to say it wasn't in the statement. Again, classification identified. There should be an identification here that says where these are reported. So all these negative numbers would be reported among the liabilities, and it would say, what liability category they're in. This, you can actually see this on the face of the financial statement. You can see all these on the face of the financial statements, which is the reason why, actually really they don't need to identify, the classification, because these are shown on the face of the financial statement. Whereas these changes in fair value, you can't see them separately from the other changes in fair value. So this is no, but whereas this no seems to be, a misapplication of the, of the standards, in this case, they're not required to identify it because it's on the face of the financial statements. The last item here, sorry, it's not the last item, the third to last item, I'm getting ahead of myself, methods and assumptions related to calculating the fair value of the derivative instruments. And in fact, later on, where they talk about fair value, they do describe here what method is used to calculate the fair values of the derivatives. The only time they have to do that is if they're not market quoted fair values. So if there is an index or an exchange or something where they can get a market quoted number, they don't have to disclose anything. They're only disclosing methods and assumptions when they have to come up with another way of determining fair value other than level 1 observable inputs from the market. So they do. And then what I'd like you to do, if they have this kind of a disclosure, is to cut and paste it into the file. And just take a look at it to make sure it all does in fact come across. Save. It's a good time to do that. If a government has reclassified any of its derivatives from hedging derivatives to investment derivatives because they terminated or they ceased to be effective or for whatever reason, then they're supposed to disclose that. We know that all 6 of their derivative instruments are hedging derivative instruments. None of them were reclassified, so there's nothing to report here. No, and since it's no, there's no amount to show here. And then one last question about the summary area is to ask about the form of the disclosures, whether it's primarily tabular, primarily narrative, or a mix of both. And I would say that this is probably a mix of both. If here's one table, here's another table, there's another table here. It's mostly narrative, to be certain. And probably some of this information in these more dense paragraphs might be a little easier to read if it were in a tabular form. But I would say, in this case, it's a mix of both. So that finishes off the summary note disclosure tab. The next tab is disclosure specifically related to their hedging derivatives. And one of the things that they're required to disclose is information about the objectives. And you can see there's a paragraph right here related to the objectives. So yes, they have identified the objectives, in this case to lower borrowing costs as compared to fixed rate bonds. So they entered into interest rate swap agreements. And you can see they go on then specifically to talk about the bond issuances that in this case actually were refunded, and they entered into these derivative instruments to hedge risk on the refunded bonds. They're supposed to say something about the context in which they did they entered into these derivatives. That's a little touchy-feely. It's a little hard to figure out. There's some of what's in here sort of speaks to context, but I actually also think that this introductory paragraph in this case really says a lot about about the context in which they did this. It talks about the refunding of the earlier debt issuances that had interest rate swaps of their own, and so I would say in this case I would say that they did in fact say something about context. They'll ask whether they say something about their strategy for hedging the risk that they're dealing with, and they do in fact say that their strategy was to lower the borrowing costs by entering into interest rate swap agreements. So yes, and do they say the type of derivatives? Yes, they're interest rate swaps. And then one last thing I'd like you to do is to copy the disclosure of the objectives into the space here, and in fact by the time you see this I will fix this so that so that it's wrapped text and let's also just make this a little bit wider so it doesn't take up as much room. So that deals with objectives. The next set of disclosures relate to terms, and you can see they actually have a paragraph here where they identify terms. They ask about the disclosure of notional amounts, which you actually see up here. So that's taken care of. Reference rates. And in fact, if you read through this disclosure of the terms, they do talk about the rates that the deals are based upon. And in fact, toward the end of this section, then, after referring to many of them during here, they present this big table here that shows all of the rates, including what the fixed payments are, what the variable payments are, what the net rates are. Yes, in fact, they do disclose the reference rates. What this is asking for is whether there are any disclosure of embedded options within the deals. I've read this, and you can take a look at it yourself. I've uploaded Riverside's CAFR to the document sharing area so that you can look at it, separately. You don't have to keep looking back at this video necessarily. And I don't see any reference to any embedded options, so the presumption there is that there aren't any. They should be disclosing the date that they entered into the hedging derivatives. I don't see that other than years. They said they did it in 2012, but other than that, there's no. I think the disclosure ought to be more specific than that. It ought to be more like month and day, and not just year. So I'm going to say no here. They should disclose the dates on which they can either be terminated or when they will mature. And in fact, they show the dates for all of these. You can see here, this one, will be around until the debt's completely retired in fiscal year 2037. This one matures in 2029. These bonds that are hedged mature in 2035, 2037, 2034. So you can see that in each of these cases the derivatives are hedging and are around as long as the debt is outstanding, and therefore they are in fact disclosing the maturity dates. For some reason I'm having trouble highlighting that, but I do it here. For some reason, every time I try to click on that, it's not working. Well, I'll have it fixed by the time you see this. I should be clicking yes here. Cash paid and received. There was no cash paid or received as a part of any of these deals up front, and so the disclosure here ought to be no. And again, I'm having some trouble here, but I promise I will have that fixed before you look at this. But we should be clicking no here. If they are hedging debt, and in fact they are hedging debt, then they are supposed to show the net cash flows of their debt hedges. And if you look on the next page here, they do that right here. For each of the next 5 fiscal years, and then in 5-year increments thereafter, principal and interest separately, the part that's related to the swap, and then the total for the whole package. So yes, they disclose that. The Statement 53, as you know, lays out 3 quantitative methods for determining whether a hedge is effective or not. But it also allows governments to use a different quantitative method that is, if they find one that is every bit as good. The board didn't want to rule out the possibility that there might be a 4th or 5th or 6th acceptable way of assessing effectiveness. But what they do require is that if a government uses a method other than those three, it has to disclose what it did. There's no such disclosure here for this government. It must have used one of the three. And so, no, there is no disclosure. If there was, I would want you to copy it into this space. So that completes that tab. Let's just click Save again to be sure. And we go on to the next set, which are notes related to risk. And in fact, you can see right after where they start talking about fair value, they have disclosures here related to credit risk. That's the first of these. So if they do have credit risk, they're supposed to disclose the ratings of their counterparties. They say the city is exposed to credit risk on one of its derivative instruments that has a positive fair value. That's that $49,000 one, I presume. And here are the ratings of their counterparties. So yes, they did show those. If they have a policy for collateral, they're supposed to disclose that. And you can see later in this paragraph it says, the swap agreements require the fair value of the swap to be collateralized by the counterparty with U.S. government securities. If the counterparty's ratings decrease to negotiated trigger points, so in the agreement, there's probably some amount, maybe it's BBB or something. It says, if you drop to that amount or below, you have to pony up some collateral. It says here that the collateral will be posted with a third-party custodian. And it says, as of the end of the fiscal year, no requirement for posting collateral has been triggered. So they do have a description, yes. There's no amount because none has been posted. And then this one, do they disclose, what access the government has to that collateral? I would say they don't. They say here that it's posted with a third-party custodian, so you might be able to infer something from that. But they don't really come right out and say, what kind of access they have to the collateral once it's been posted. If a government has engaged in master netting agreements, they will very clearly disclose that. There's nothing in this disclosure about that, so the answer is no. Again, don't seem to be. This doesn't seem to be working here, but I will have that fixed for you before you get to it. If it was yes, then I'd ask you to insert the amounts here. If they have assets that are in, if they have hedges that are in asset positions, they're supposed to disclose the aggregate fair value of those hedges. They've only got one, so there really isn't anything else for them to do. We know that there's the one. They have said here that they have the, the one derivative instrument that has a positive fair value. So there really is nothing else for them to do. So I would give them a yes on that. If they have concentration risk, meaning they have credit risk, and it relates to a value that's above a certain percentage, I believe it's 5% of their total, then they will disclose what the concentration risk is. They don't have it, so it's not disclosed. If it was, I'd ask you to copy the disclosure into this space here. The next type of risk is interest rate risk, and if you look at here, they basis risk, termination risk, but nothing about interest rate risk, so the presumption again is that they're not exposed to it. We're not here to be judgmental, just to say whether they've disclosed it or not. If they do disclose interest rate risk, they have to disclose the terms that increase that risk, and so I would ask you to identify whether they have or not, but since they don't disclose, you don't have to put anything in there at all. If they have basis risk, they're required to disclose it. You can see that in fact they do. So yes, they disclose it. They're also supposed to disclose the terms that create the basis risk. And if you read through this, I think you will see that in fact it explains how their basis risk arises. So I would say that in fact they do disclose the terms that create the risk. The next type of risk is termination risk, which you can see they do in fact disclose. I'll give them a yes for that. In their disclosure, they should identify what the termination events are, the things that could lead to terminating the derivative. They mentioned that they use the International Swap Dealers Association Master Agreement, which is basically a form agreement, and many, if not the overwhelming majority of swaps are based upon that master agreement, which, among other things, includes standard termination events, as it says here, such as failure to pay or bankruptcy. So they do, in fact, identify that. They also have some other things that they added. It says the additional termination event, which is that if the city can terminate it if either counterparty's credit quality falls below BBB minus, as measured by Standard & Poor's, or the city or the counterparty may terminate the swap if the other party fails to perform under the terms of the contract. Dates that the derivative may be terminated. In some cases, the agreements will say that, that there are specific junctures during the life of the agreement when termination can happen. There's no specific dates in here at all related to that, so the answer is no. And there also don't appear to be any out of the ordinary events disclosed here. If there are things that are unusual, as termination events, they are supposed to be disclosed separately. If the answer had been yes, I would like you to copy the disclosure into the spreadsheet. The next risk is rollover risk. There's no evidence of any disclosure of that here, so we're going to say no. If they did disclose rollover risk, they would need to disclose the maturity date for the derivative and the maturity date for the hedged item. And that's the nature of rollover risk, that the hedged item lasts longer than the derivative, and so after the derivative ends, you no longer have the protection of the hedge. And if there's some reason to believe that they can't just enter into another derivative to continue hedging against that item, that's what rollover risk is considered to be. And then the last of the risks is foreign currency risk. They do not have that, so they don't disclose it. If they did, then they need to disclose what their US dollar balances are for all of the affected hedges, and they should be organized by the foreign currency and then also by the type of derivative. And then one more tab, this is the last one, other notes relating to contingent features. They do not, I didn't see anything in this note disclosure about contingent features, so the answer is no. Don't be confused by this is another note. Note 10 is the derivatives. This is note 11, economic contingency. It doesn't have anything to do with the derivatives. The first time I saw that, I thought there was, but then I read it and then I saw, the number is there. It's a different note, so it's not related to derivatives. If they did have contingent features, they'd be required to disclose the nature of those features and what triggers them, what the aggregate value is of the derivatives that are affected by these contingencies, the amount of required collateral or transfer of other securities under the terms of the contingencies, because as you saw with the government, where it actually has one where the counterparty is required to post collateral, and they tell you the circumstances under which they have to. The terms might also say something about the amount that has to be posted or transferred. In this case, we're talking about contingencies that affect the government, where the government would have to post collateral. And sometimes they will identify what that amount is that they have to post. So you would click yes or no if they had. And then if any amount has actually been posted, they should disclose the amount that has been posted. And that's what I'd like you to actually to say yes or no here, not to post the amount. And then if they have synthetic guaranteed investment contracts, or SGICs. They are required to disclose information about that. They do not, in fact, have any SGICs, so you just do no here, and you don't have to do anything else. If they did, they would have to describe the nature of those SGICs, the value, whether the value of the wrap contract had been disclosed, and whether the value of the underlying instrument had been disclosed. They need to be disclosed separately. And with that, that's the end of the data entry. You should, of course, go back and make sure, look at it at least a few times to make sure you entered all the information correctly. Make sure you save on a regular basis. You know that, in the discussion threads for weeks 13 and 14 are for posing questions about the data entry, about any issues you're having in trying to find the information in the financial reports that you were assigned. You post the questions there, and I will answer them, and maybe your fellow students in the course might have answers as well based upon their experience in looking through the financial statements. And don't hesitate to post questions there. I will try to answer them at least once a day during weeks 13 and 14. So good luck with the assignment.